Something changed in January 2024, quietly, without headlines, without announcement. The Bank for International Settlements, the central bank of central banks, released a memo that redefined silver as a Tier 1 asset. That means silver now sits in the same category as cash, treasury bonds, and gold. The same institutions that spent 50 years treating silver like an industrial commodity suddenly reclassified it overnight as monetary collateral. They didn't hold a press conference. They didn't explain why. They just changed the rules and moved on. That memo was Basel III. And if you don't know what that means yet, you're about to understand why banks have been accumulating silver in silence while telling the public absolutely nothing. This isn't speculation. This is policy. This is regulatory structure. This is the quiet rewriting of the global financial system while everyone was distracted by rate hikes, crypto crashes, and inflation headlines. And the most dangerous part? The math behind this move suggests silver isn't heading to $100 an ounce. It suggests $500 is conservative, not because of speculation, not because of hype, because of supply, demand, physics, and the one thing banks can't print, actual metal. Let's start with what they don't want you to see. Silver has been suppressed for decades, not theoretically, not in some conspiracy form, suppressed through regulatory structure, paper contracts, and deliberate misclassification. For 50 years, silver was treated as a commodity, industrial, disposable, tradable in infinite paper derivatives with almost no physical delivery required. The COMEX, the exchange where silver futures are traded, operates on a system where less than 1% of contracts ever demand actual metal. That means you can sell silver you don't have, buy silver that doesn't exist, and settle the entire transaction in cash without a single ounce changing hands. It's a paper market floating on top of a physical reality. And that worked perfectly fine as long as no one asked for delivery. But now someone is asking. And that someone is every major bank on the planet. Here's the mechanic they buried in regulatory language. Under the old system, Basel II, silver was classified as a Tier 3 asset. That meant banks couldn't use it as high-quality collateral. It was useful for industry, for jewelry, for solar panels, but it wasn't money. It wasn't reserves. It wasn't something you could hold on a balance sheet to meet capital requirements during a crisis. Gold was, treasury bonds were, cash was, silver wasn't. That kept institutional demand low. That kept the price suppressed. That kept silver cheap, abundant, and irrelevant to the financial system. But Basel III flipped that. Now silver qualifies as Tier 1. Now it counts as reserve capital. Now banks can hold physical silver and use it to meet the same liquidity requirements they used to meet with sovereign debt. Why does that matter? Because sovereign debt is currently imploding. Treasury yields are rising. Bond prices are collapsing. The 40-year bull market in government bonds is over. That means the collateral banks have relied on for half a century is losing value in real time. And when collateral loses value, banks need to replace it, fast, quietly, without spooking the market. Silver just became the only replacement that isn't controlled by a central bank, isn't tied to a government, and can't be printed into irrelevance. Now ask yourself this. If you're a major bank and you just got regulatory approval to treat silver as Tier 1 collateral, and you know treasury bonds are losing value, and you know physical silver supply is the tightest it's been in 40 years, what do? You buy. You buy quietly. You buy through intermediaries. You buy off exchange. You buy before the price reflects what you know. And you absolutely do not tell the public, because the moment retail figures this out, the premium explodes, and your accumulation window closes. That's what's happening right now. Banks are not talking about silver. CNBC isn't running segments on silver. Bloomberg isn't covering it. The financial media is completely silent on the one asset that just became systemically critical to bank balance sheets. Why? Because silence benefits accumulation. Noise benefits distribution. Right now, they're accumulating. Later, when they're done, when they've locked in their positions, when the vaults are full, that's when you'll hear about it. That's when the headlines will start. That's when the narrative will shift. But by then, the price will already reflect reality and the opportunity will be gone. Let's talk about supply. Because this is where the math becomes unavoidable. Silver is the most conductively efficient metal on Earth. It's irreplaceable in solar panels, in electric vehicles, in 5G infrastructure, in AI server farms, in military technology. Every major economy on the planet is electrifying. Every data center expansion requires silver. Every renewable energy target requires silver. Every semiconductor, every circuit board, every high-efficiency conductor requires silver. And none of that demand is speculative. It's engineered. It's locked in. It's mandated by government policy, by corporate infrastructure, by the physics of how electricity moves through matter. Global silver production is roughly 880 million ounces per year. Industrial demand alone is approaching 1 billion ounces per year. That means the market is already in deficit. Every year, more silver is consumed than is mined. And unlike gold, which sits in vaults and gets recycled endlessly, silver gets used. It gets embedded in solar panels that last 25 years. It gets soldered into circuit boards that end up in landfills. It gets consumed, dispersed, and effectively lost. There is no strategic silver reserve. There is no government stockpile ready to flood the market. The US government sold its entire silver reserve decades ago. China has been importing silver for 15 years. India consumes massive quantities for cultural and industrial use. And now, on top of all that existing demand, you have every major bank on earth treating silver as monetary collateral. That creates a structural problem. Because if banks start holding silver the way they hold gold, if they start accumulating physical metal to meet regulatory requirements, they're not buying paper contracts. They're buying actual bars. They're taking delivery. They're pulling metal out of circulation. And when you remove supply from a market that's already in deficit, the price doesn't rise gradually. It gaps. It dislocates. It moves in ways that break models, that freeze trading. That force margin calls across the entire paper derivative complex. Here's what most people don't understand about the COMEX. The exchange operates on leverage, massive leverage. For every ounce of physical silver in the COMEX vault, there are hundreds of ounces of paper claims against it. That system works perfectly as long as no one demands delivery. But the moment you get sustained physical demand, the moment banks, industrial users, and sovereign buyers all start asking for metal. At the same time, the system fractures. You get delivery failures. You get cash settlements at penalty premiums. You get force majeure clauses invoked. You get the entire paper market revealed as a synthetic construct that was never designed to deliver physical metal at scale. And that moment is approaching because the banks aren't waiting. They're moving now. You can see it in the data if you know where to look. COMEX registered silver, the portion of inventory that's available for immediate delivery, has been draining for months. It's sitting near multi-year lows. Meanwhile, silver imports into London, the other major physical hub, have been surging. That's not retail. Retail doesn't move that kind of volume. That's institutional. That's size. That's someone, or multiple someones, building positions in physical metal while the price is still quoted in paper terms. Now let's talk about price suppression, because this isn't new. Silver has been deliberately kept cheap for decades, not through conspiracy, through structure, through the incentive design of the derivative market. When you allow unlimited paper contracts to be written against limited physical metal, you create artificial supply. You flood the market with sell orders that don't represent actual metal. That pushes the price down. It keeps it stable. It prevents volatility. And it works beautifully as long as the financial system doesn't need silver as collateral. But now it does. Basel III changed the game. And when regulatory structure shifts, price suppression becomes impossible, because the banks that were profiting from the paper market are now the same banks that need physical metal. They're on both sides of the trade. And when you're on both sides, the side that controls physical reality wins, always. Paper contracts are claims, physical metal is settlement. And in a crisis, settlement is the only thing that matters. Here's the escalation path. Right now, silver is trading around $30 an ounce. That price reflects the paper market. It reflects synthetic supply. It reflects the assumption that industrial demand can be met, that financial demand is negligible, and that the system will continue functioning the way it has for 50 years. But every one of those assumptions is breaking. Industrial demand is accelerating. Financial demand just became structural. And the system is already showing stress. When those assumptions fully collapse, when the market reprices silver based on physical availability rather than paper liquidity, you're not looking at $50. You're not looking at $100. You're looking at a price that reflects the actual cost of replacing Treasury collateral, of meeting Tier 1 capital requirements, of securing supply in a deficit market during a global electrification build-out. $500 per ounce isn't a prediction. It's a calculation. If banks need to replace even a fraction of their bond collateral with physical silver, if sovereign buyers start accumulating the way they've accumulated gold, if industrial users start stockpiling ahead of shortages, the available supply disappears. And when supply disappears in a market where demand is non-negotiable, price becomes whatever the last buyer is willing to pay. That's not speculation. That's auction theory. That's market mechanics. That's physics. And the banks know this. They're not buying silver because they think it might go up. They're buying because the regulatory environment just forced them to care about an asset they ignored for half a century. They're buying because their collateral base is deteriorating. They're buying because physical metal is finite and policy-driven demand is infinite. And they're doing it quietly, methodically, without signaling intent. Because the moment the market realizes what's happening, the premium explodes and the game is over. Now here's the part that should terrify you. The public has no idea this is happening. Retail investors are still trading meme stocks, speculating on AI narratives, chasing crypto pumps, buying index funds, and trusting that the financial system will continue operating the way it always has. They're not watching Basel III implementation. They're not tracking COMEX inventory. They're not calculating supply deficits or analyzing bank balance sheets. They're trusting the price they see on their screen, not realizing that price is a derivative of a paper market that's about to be overrun by physical demand. And when they do realize, when the headlines finally catch up, when CNBC starts running breathless segments about the silver shortage, it'll be too late. The metal will be gone, the premium will be prohibitive, the institutions will already be positioned, and retail will be left chasing price, buying at the top of the media cycle, wondering why no one told them earlier. But someone did tell them. The banks told them. They told them by changing the rules. They told them by reclassifying silver. They told them by accumulating in silence. They just didn't announce it, because announcements are for distribution, not accumulation. Let's address the volatility question, because silver is volatile, wildly volatile. It moves faster and harder than almost any other asset. And that scares people. They see the price spike, they see it crash, and they assume it's just speculation, just traders playing games, just noise. But volatility isn't weakness. Volatility is a symptom of a thin market with inelastic supply meeting surging demand. Gold is stable because it has deep liquidity, massive central bank holdings, and minimal industrial use. Silver is volatile because it has shallow liquidity, no government stockpiles, and massive industrial consumption. When demand surges, the price rockets. When demand pauses, the price collapses. That's not manipulation, that's structure. But here's what changes under Basel III. When banks start holding silver as Tier 1 collateral, they don't trade it, they vault it. They hold it as reserves. That removes supply from the market permanently. And when you permanently remove supply from a volatile asset, you don't reduce volatility, you increase it. Because now every marginal buyer is chasing a shrinking pool of available metal. Every industrial user is competing with financial institutions. Every price spike becomes more extreme. Every dip gets bought faster. The volatility doesn't disappear, it amplifies. And the only people who benefit from that are the ones who positioned early, who bought physical, who understood the regulatory shift before the market priced it in. Now let's talk about what happens when the price breaks. Not if, when. Because the math is locked in, the demand is locked in, the deficit is locked in. The only variable is timing, and timing is controlled by how fast banks accumulate, how quickly industrial users stockpile, and how long the paper market can suppress price before physical demand overwhelms it. When that break happens, you won't see it coming gradually. You won't get a gentle uptrend with clean pullbacks and predictable technical levels. You'll get a gap, a disorderly repricing, a moment where the bid-ask spread blows out, where liquidity vanishes, where the market realizes there's no metal available at current prices, and the quote jumps 10, 20, 30% in a session. That's not fear-mongering. That's historical precedent. Silver has done this before. In 1980, it went from $6 to $50 in months. In 2011, it went from $18 to $49 in less than a year. In both times, the move wasn't driven by fundamentals improving gradually. It was driven by a sudden realization that supply was finite and demand was immediate. This time is different only in scale, because this time it's not just speculators, it's banks, it's regulatory requirements, it's Basel III compliance. It's the entire global financial system realizing it needs an asset it spent 50 years pretending didn't matter. And here's the cruelest part. The media will cover it after it happens. They'll write the articles explaining why silver surged. They'll interview analysts who will say it was obvious, that the signs were there, that everyone should have seen it coming. They'll frame it as a story, a narrative, a moment in financial history, but they won't tell you beforehand. They can't. Because the institutions that advertise on their networks, that sponsor their programming, that fund their existence, are the same institutions that are accumulating. And you don't advertise your position before you're done building it. So where does this leave you? It leaves you with a choice. You can ignore this. You can assume the system will continue operating the way it has, that silver will remain cheap and available, that the banks are wrong, that Basel III doesn't matter, that the supply deficit is exaggerated. You can trust the price you see on your screen and believe that if something major were happening, someone would tell you. Or you can look at the regulatory structure, at the inventory data, at the demand trajectory, at the incentive alignment, and recognize that the banks are moving for a reason. They're not speculating, they're complying, they're positioning, they're preparing for a financial environment where Treasury bonds aren't safe collateral and physical metal is the only alternative. This isn't a warning. This already started. The memo was published. The rules changed. The accumulation began. The only question left is whether you're early or late, whether you're positioned with the institutions or chasing them, whether you understood what Basel III meant in real time or read about it in hindsight after the price already moved. Because the banks aren't buying silver hoping it goes up. They're buying because the regulatory environment just made it mandatory. They're buying because their bond collateral is losing value. They're buying because the supply is finite and the demand is structural. And they're doing it in secret, not because they're hiding, but because silence is strategy. Accumulation happens in quiet. Distribution happens in noise. Right now, it's quiet. And when the noise starts, when the headlines begin, when the price reflects what the banks already know, the opportunity will be over. The math will be locked in. The metal will be vaulted. The system will have repriced. And you'll be left watching from the outside, wondering why no one told you sooner. They did. They just didn't use words. They used policy. They used Basel III. They used regulatory structure. And if you were paying attention, if you understood what Tier 1 reclassification meant, if you connected the dots between collateral requirements and supply deficits, you saw it coming. The question isn't whether silver hits $500. The question is whether you're positioned before the market realizes it has to. Because once the market realizes, once the bid-ask spread blows out, once the COMEX inventory drains, once delivery failures start, once the banks finish accumulating and start defending their positions, the window closes. Not gradually, instantly. So here's your question, and I want you to answer this honestly in the comments. If the banks are quietly reclassifying silver as Tier 1 collateral and accumulating physical metal while the public remains distracted, what does that tell you about where the price is headed? And more importantly, what does it tell you about how much time you have left to position before the market catches up? Think carefully, because the institutions already answered that question. They answered it by changing the rules. They answered it by moving in silence. And they're counting on you not noticing until it's too late. The math is already locked in, the demand is structural, the supply is finite, and the banks don't gamble. They position. They're positioned now. The only question is whether you are.